Hey everyone, it's Mark. I'm here to help you put more money in your pocket through credit cards and smart financial habits. If that sounds good to you, then please let me know by clicking the like and subscribe buttons down below. And with that said, I want to welcome you to Credit Cards 101. This is going to be one of the most important educational and impactful videos if you are a beginner to credit cards. And for that reason, I invite you to stay all the way to the very end of this video, literally the last second. So if you want to learn how to use credit cards to make money, save money, increase your credit score, and have zero debt, this video is designed specifically for you. And to keep things extremely simple, I'm going to break everything down into 5 simple rules that you can follow. So let's begin with rule number 1, which is to use credit cards like a debit card. What I mean by that is to always spend less than you make. Hold yourself to a monthly budget and buy what you can pay off in cash that will keep you debt-free. One of the most important things that you can do is to set a budget and stick to it. I'll link to a budget right here on the pop-out banner of how to design that budget on Excel in a very simple way. That way you'll have more control and insight into your finances. Rule number 2 is to start your credit journey the right way. A good first step here is to become an authorized user on somebody else's credit card. This is optional, but it can be extremely helpful to you. Choose someone with strong credit already. By that, I mean a strong score and solid payment history and other factors too. Perhaps a friend or a family member that's been using credit for many years. And this is also great if you're having trouble getting approved for a card of your own. Doing this allows you to actually have other people's positive payment history and credit score appear on your credit report. That way you can leverage it to apply for your own cards and get started much faster. The next best step is to get your first credit card in your name. Oftentimes it's easiest to get started with a secured credit card, which requires you to put a deposit down that becomes your credit limit. So if you put a deposit of $500 down, you now have a $500 limit on that card. From there, you can get your second credit card, and this will be an unsecured line of credit, which is basically a regular credit card. Ideally, this card should have no annual fee because you're going to end up keeping this one long-term to build a long credit history, and so to have no fee associated with that is a very good thing. A simple general rule to follow here is to keep your secured credit card building history with that one for about a year, and then after that year, go ahead and apply for your first unsecured credit card, because by that time you'll have some good history built up and a much higher score, which will increase your chances of being approved for that second card. Now, if you're wondering how often should I get new credit cards, well, like I said, first build credit with 1 or 2 cards for a full year and get your FICO score to around 680 or higher. Then you can typically get 1 new card every 3 months or so. That tends to work well with most card issuers as a general rule. Which bank should you start with? I usually say Chase because they have a 524 rule. That simply means they will automatically deny your application if you've opened up 5 or more credit cards with any bank in the last 24 months. Now let's move into rule number 3. Understand your credit score. A lot of scoring models range from 300 up to 850. Anywhere from 300 to 549 is considered bad credit. 550 to 649 is poor. 650 to 699 is fair. 700 to 749 is good, and 750 and above, all the way up to 850 is excellent credit. The actual tier or bucket that you fall into is much more important than the exact number of your credit score. Now, your credit score has 5 major components, and the easiest way to remember that is FIRLAMENA. FIRLAMENA is an acronym, and each of the 2 letters represent one of those 5 factors. PH is payment history, followed by utilization ratio, length of credit history, which is also called average age of accounts. Your mix of accounts is the 4th factor. And lastly, factor number 5, new accounts. And it's a weighted average. So payment history makes up 35% of your score. Utilization ratio is 30%. The length of your credit history is 15%. And both your mix of accounts and new accounts contribute 10% of your weighted overall score. Let's take a look into each of these with a little bit more detail. Starting with payment history. Always pay your bill on time. Ideally, it's best to do it before your bill's date. I usually suggest about 3 to 5 days before that due date to ensure that it gets in on time. Utilization ratio refers to how much of your credit is being used, and that goes across all of your cards and individual cards. To figure out what your utilization ratio is, simply divide the balance by your limit and then multiply by 100. So if you have a $550 balance on your credit card and your limit is $2,500, simply divide 550 by 2,500, multiply that answer by 100, and you'll get an answer that's 22. In other words, you're using 22% of your current credit limit on that card. This same formula applies when you're looking at all of your cards. If you have 2 or 3 cards, add all of your balances across all of your cards, divide that total balance number by the total amount of credit you have across all of your cards, multiply by 100, and then you'll have your utilization across your entire credit card portfolio. Overall, it's best to keep your utilization on individual cards and across all of your cards under 30%. It's not required. You do have a credit limit for a reason. You can spend up to that limit, but it'll keep your credit score a lot higher the lower percentage you're using of your credit. And as a beginner, you're likely just getting started. You might have a very small credit limit. Let's say it's $500 or $1,000. Feel free to make some early payments. You can pay your bill multiple times per month. So if you max it out, go ahead and submit a payment to bring it back down. Length of credit history refers to the age of your oldest card, the longer the better, and the average age of all of your cards factored together. Again, the longer the better. As a pro tip, be sure to get a card with no annual fee early on and just keep it open long term. Even if you eventually outgrow that card or move on to other card products, you can still put 1 purchase on that card every 6 months or so, maybe 2 purchases per year, just to keep it active, but that card will serve you extremely well in helping to build a long length of credit history. Mix of accounts refers to the types of accounts on your credit report. This includes multiple credit cards, auto loans, mortgages, perhaps a student loan, and other financial products. Having more types of accounts can help your score, but again, this is a small factor, only 10%, so you don't need to put a whole lot of emphasis on this. In general, just get the financial products that you absolutely need. By the way, you can go a very long way with just 1 credit card, so get started very simply and grow over time based on your actual needs. And lastly, new accounts also making up 10% of your score. This is the number of new accounts you've opened, usually within about the last 12 months. Again, including multiple credit cards, auto loans, mortgages, anything that appears on your credit report. The age of that is important to consider. The newer, the worse for your score. So here, the fewer, the better. The best practice is to not open new accounts frequently in a short period of time. Keep all of your credit cards for at least 1 year before canceling. Rule number 4 is to learn the credit terminology. And let's begin by talking about credit limits / credit lines. Those 2 words are synonymous. They mean the same thing, and it represents the total amount of money you can spend per billing cycle. In other words, about a 30-day period. The limit you get is based on your credit score, your income, and other factors. A billing cycle is the amount of time from one statement or bill and the next one. The open date is the first day of your billing cycle, and the close date is the last day. Each billing cycle is about 30 days and includes all purchases made within that time frame. Now check this out. The open date is usually related to the day of the month you first opened your account. Therefore, your billing cycle is not necessarily January 1st through January 30th, but it could be January 16 to February 15. The 30-day period can be totally different for you versus somebody else. And a very simple way to figure out what yours is on your bill. So once you get that first statement on your credit card, look somewhere. It's typically on the top or somewhere on the first page. It shows you the open date or at least just the close date. And that close date is very important to know. As you see in the example here, it opened on August 17 and closed on September 16. That was that 30-day cycle. So if you learn your close date is the 16th of every month and you've maxed out your card, you might want to pay that down a little bit before your close date. That way a smaller balance gets reported and therefore your utilization will be lower, therefore driving your credit score up. Now the balance itself is the total dollars spent on your card at any moment in time. And as I just mentioned, the balance on your statement or your bill is the amount that was reported to the credit reporting agencies, which are also called the bureaus. The minimum due is the smallest amount you can pay for an on-time payment to be reported and therefore build positive credit history. However, the remaining balance that does not get paid off gets charged interest. Fortunately, you can avoid interest altogether by paying off the balance in full. The due date is the last day you can pay your bill for an on-time payment. Only the minimum is required, but again, pay in full to avoid interest. The due date is usually about 25 days after your billing cycle ends. Your annual percentage rate, or APR, is the interest rate you'll pay per year on your balance carried past the due date. If you ever want to know how much interest you'd pay per month, you can calculate your monthly interest rate by taking that APR and dividing it by 12. Again, avoid interest by paying the entire balance before the due date. So as an example here, you can see that the APR is 16.99% on this card. Therefore, the monthly rate is 16.99% divided by 12, or about 1.415%. So a balance of $2,000 would start charging you $28.30 in interest per month if not paid off before the due date. And obviously that can add up quite quickly month after month. So again, pay your balance in full to avoid this completely. A balance transfer is when you transfer the balance from one card to another. Normally there's a one-time fee of about 3% to 5%. And this can be a good tool to help you pay down debt if there's a promotional rate. For example, 0% APR on balance transfers for X amount of months. So look at the left-hand side of your screen on the before column. Card A, let's say that's a credit card you already had for a while, and you had a $2,000 balance on there that you couldn't pay off, so you were carrying that balance 1 month after the other. The APR, let's say it was 18%. Therefore, you're being charged $30 per month in interest to carry that $2,000 balance. Now, to help yourself get out of debt and pay down that balance, let's say you get a new card. Card B. Because that card's brand new, it has a balance of $0. But let's say there was a promotional rate that came with the card of 0% interest on balance transfers. Therefore, you'd be paying $0 per month in interest. So here's what you could do in that scenario. Look at the after side on the right-hand side of your screen. Card A used to have a balance of $2,000. But you transfer that balance to card B. So now card A has no more balance on it. The card still has an 18% interest rate, but because there's no balance, you're no longer paying any more interest on card A. However, card B is now going to carry your $2,000 balance going forward. The difference has to do with that promotional rate that card B has. There's now 0% interest on balance transfers. Therefore, you'll also be paying no interest per month on card B. However, you paid a one-time fee of 3%, and 3% of $2,000 was $60. So you can see how that would be a huge help to you if you've had a balance for a while, you've been in debt, and you want to get yourself out. I know it sounds crazy at first to use credit cards to get out of debt, but if you do it the right way, it can be a huge help and very effective. If you do it in the way that I just showed you, this can be a super smart approach because for a one-time fee of, let's say, $60, you now have eliminated interest completely from both credit cards. And since you're not being charged interest, you can now put more money toward paying down that balance to pay it down even faster than you could have before. Now let's take a look at a cash advance. This is where you borrow against your credit limit to get cash. For example, you can go to an ATM, stick your credit card in the slot, withdraw $300 of cash, but now you have a $300 balance on your credit card at a very high interest rate. Look at the example here. The interest rate for cash advances is 26.99%, almost 30%. You definitely want to avoid cash advances at all times. You can even forget about this term if you want to. I'm just showing you here, so when you see your bill at the end of the month and it shows you cash advances, I want you to know what it is, but this is not something that you should ever play around with. The annual fee is the cost to carry a card each year. Cards with annual fees tend to have more rewards and benefits. That's what you're paying for. As long as the rewards, the cashback, the benefits, the insurance coverages, etc. that you receive from your credit card are worth more to you than the annual fee, then it can definitely make sense to get a card with an annual fee. However, that's not required. There are plenty of great cards out there with no annual fee if you want to avoid those for now. A hard inquiry or a hard pull is a request by a business to view your credit report when applying for additional credit. This does show on your credit report as an inquiry, and it temporarily lowers your credit score by several points. Your score normally rebounds, however, after a few months, and there's no harmful effect after 1 year. Hard inquiries fall off of your credit report entirely after 2 years. On the other hand, a soft inquiry or a soft pull is also a request by a business to view your credit report without applying for additional credit. In other words, they're just viewing it only. These do not affect your credit score or your credit report in any way. A credit bureau is a company that collects credit data and sells it to lenders, creditors, banks, and consumers in the form of a credit report. Banks use this information to determine whether or not to issue lines of credit to people. There are a lot of different credit bureaus out there, but the main three that you're probably most familiar with are TransUnion, Experian, and Equifax. Now let's talk about a product change. This is where you change from one credit card to another. Your account age, payment history, credit line, and more all remain intact. Therefore, your credit score or your credit report is not affected when you do this. And in most situations, your 15-digit or 16-digit credit card number remains the same as well. In other words, think of this like your account itself remains open, but the actual card product that your account is associated with changes. So when you upgrade, you go to a higher fee card, and when you downgrade, you go to a lower fee card. Do note that when you do these upgrades or downgrades, you do not receive any sign-up bonus when you do so. However, this is a great way to get out of a card with an annual fee and keep it long-term as a no-fee card. And last up, we have rule number 5. Earn the right rewards for you. That begins by choosing the reward type that matches your goals. Do you want cash? Get a cashback credit card. Do you want to travel? Get a points credit card. Also be sure to choose the reward categories that match your spending habits. For example, do get a card that earns 3x points or 3% cashback on dining if you eat out often. However, do not get a card that earns triple points or 3% cashback on department stores if you do not shop often. And lastly, be sure the card you're applying for has reward redemptions that you value, whether it's cashback, statement credits, gift cards, online shopping, travel, charitable donations, and more. When people ask the question, what credit card should I get? These are the 3 main things you want to ask yourself. Make sure that the card you get fits in with your spending habits and your reward preferences. The credit card you pick is actually a lot like the clothing that you wear or the accessories that you put on with your outfit. There is no one credit card that's a one-size-fits-all. So take a look at where you spend your money and what you value to get back, and then get a credit card that matches your particular lifestyle. And there you have it. I realize that was a ton of information, so if you want to watch this video 2 or 3 times over, feel free to do so. But nonetheless, I hope it was extremely helpful to you when getting started with the credit card game. And if you follow the information within each of these 5 rules, you'll be off to a fantastic start building a healthy credit score and credit report overall, putting tons of money in your pocket, and staying debt-free. To recap all 5 rules, I'll put them all here on one slide on the screen for you. Feel free to screenshot this and keep it somewhere. And of course, go back to each individual section if you want to go over the information underneath each rule. If you enjoyed this video and found it helpful and also believe it can benefit others, then please help me get it in front of more people by liking this video, subscribing to the channel, and turning on notifications. And of course, if you have any questions about the information that we covered in today's video, let me know in the comments down below. I'm happy to help you out. I'll see you all again in future videos, and until then, remember, you are great.